Hello, everyone. My name is Talitha Bulaya, and I'm a senior card specialist at Zambia National Commercial Bank. I'm passionate about driving innovation in the digital banking world. I have over 40 years of banking experience. I'm also a certified digital finance practitioner and an associate of the Chartered Institute of Marketing. I'm a proud gender equality change maker under Digital Frontiers Institute, and I am thrilled to be able to share my insights with you today. First, we can start with some housekeeping. So, if you want to speak, please raise your hand or you can type in the chat box. When the speaker is speaking, please make sure that your mic is muted so that we have no background noises. And please note that this session is being recorded. So as a senior card specialist, I've seen how the landscape of risk has transformed over the years. And in today's digital age, the challenges have become more complex and dynamic, requiring us to become more vigilant than ever before. So today we'll explore how we can move from a state of vulnerability to a state of vigilance in a digital age. So this is what we'll cover: the key risk areas, risk identification and assessment, managing cybersecurity risks, fraud prevention strategies, operational risk mitigation, and the future of risk management. Like I said, I have over 40 years of banking experience, and I just wanted to take you from what banking was like in the 1980s to what banking is like now in 2025. So when I joined the bank, what you're seeing there in the middle, that is the NCR 400 series. That was the machine that we used for posting all the transactions. And banking was pretty much a static building. As you can see, there's a queue of customers lining up for their turn so that they can be attended to. But when you look at banking in 2025, it's available 24/7. You have the ATM, you have internet banking, you have mobile banking, and you have tap and go and cardless transactions. Basically, banking is at the fingertips of our customers, but this causes risks. So I just wanted to feel the room, the temperature in the room, by running a quick poll. And so the question is, what do you think is the biggest risk in digital banking today? Is it cybersecurity threats? Is it fraud and identity theft? Is it system downtime and outages, or poor data governance, or lack of customer trust? You may go ahead and answer. Are we able to see the poll results? Okay. So 35% feel that cybersecurity threats are the biggest, though 45% feel fraud identity theft. Yes, when we look at the world that we live in, where people can steal your identity and pretend to be you, that is a major risk. And then cybersecurity, just one misconfiguration can bring down a whole system, a whole organization. System downtime and outages, yes, those do happen, but I think we can live through those. Data governance causes breaches for customers. And when the customer does not trust us, then our business is at stake, because when you look at banking, our business is hinged on customer trust. Thank you. We can go to the next slide. So I just wanted us to go to the basics. Yes, in simple terms, to just understand what is risk management. So it's basically, risk is the possibility of something going wrong and causing harm or loss. And in the digital banking space, it takes new dimensions. When we look at cyber um, security threats, fraud risks, operational risks, and we'll also explore why digital banking platforms face these unique challenges and understand the fundamentals that help us to appreciate these modern complexities. So the digital banking landscape has shifted from face to face, from brick and mortar, to tech driven platforms. And this offers our customers speed, convenience, and innovation. However, it introduces new risk. The role of risk management in digital banking is to ensure security, compliance, customer trust, innovation, while protecting the institution from financial and reputational damage. And go to the next slide. So the key risk areas, we have cyber security. This is the digital equivalent. So I want you to imagine a fortress under siege. It's about protecting sensitive data from hackers and cyber attacks that could compromise customer trust. An example is of Capital One, which in 2019 had a data breach. Hackers exploited the vulnerability of the bank's cloud infrastructure and gained access to personal information. Yes, and personal information for about 100 million customers. So this breach exposed social security numbers, account numbers, names, and credit scores. How did the vulnerability occur? This was as a result of a misconfiguration. So what were the next steps taken? After this incident, the bank strengthened their security protocols. When we look at fraud risk, think of this as an ever evolving game of cat and mouse, where fraudsters are constantly finding new ways to exploit vulnerabilities and making it crucial for the institutions to stay one step ahead. How quickly do these fraud tactics change? Sometimes every hour, sometimes every day. So there's need for a constant upgrades of security measures to be able to stay ahead of fraudsters. In today's age, we have fraudsters who create fake videos and make them appear real. Operational risk. This is a risk of something going wrong in the day-to-day running of the bank, whether it's system glitches, human error, or process failure. In 2025, in July, on the 25th of July this year, 2025, Starlink had an outage that lasted for 45 minutes. And it affected different institutions and different individuals. Each one of us was affected differently. But the importance that came out of this was the importance of redundancy and quick response to technical challenges in the tech-driven services. Risk compliance is about staying on the right side of the law. It involves adhering to regulations and avoiding penalties that could arise from non-compliance. In 2023, Deutsche Bank was fined for failing to comply with anti-money laundering regulations. The fine was as a result of inadequate controls to detect and prevent money laundering activities. This incident underscored the importance of having a robust anti-money laundering measures to avoid legal and financial repercussions. When we look at credit risk, this is where the bank or the lending institution has to play the detective and assess the likelihood of the borrower to be able to pay back what they are what they've borrowed. So banks use credit scoring methods to mitigate this risk. Under reputational risk, this is the negative publicity that could damage an institution's reputation. It's about maintaining trust and confidence with customers. We can go to the next slide. So here we're looking at risk identification methods. Banks use multiple methods to identify and prioritize risks. Automated monitoring and alerts, constantly watching transactions for anomalies, other transactions outside of what is the norm. Behavioral analytics flag unusual activity. For example, if I am a card holder and I only do small transactions within the domestic market, and then all of a sudden you see that I've gone online and I'm making huge purchases, that is a transaction anomaly, and the system needs to detect that. Also, the need for regular audits and penetration testing. This helps us to identify the weak points before attackers do. Customers' feedback and incident reporting. This helps us with real-world insights and potential vulnerabilities. So think of risk assessment as you protecting your home. First, you identify which doors or windows are vulnerable. Then you decide which security measures to prioritize based on the potential damage. We can go to the next slide. So on the risk scoring models, you look at the impact versus the likelihood of it happening. And it is better that both we prevent anything from happening. And prioritizing risk-based potential on damage. So you have high risk, things like phishing attacks, and medium, where you look at the system downtime, um, and the customer alerts for suspicious activity. So there are those alerts that we'll send to customers, like in the bank, we'll send alerts to customers for every transaction that they'll make. This will help us to detect if this has been done by the customer, or if when the customer applies for the card, we will send them a message telling them that their card is ready. If this is not from them, the customer will be able to call the bank and say, I've received this alert, but it's not in line with what I was doing. So it's not in line with what I requested for. So this will help us prevent the card going to the wrong customer. We can go to the next slide. So I just want to hear from you by running this poll. What do you think worries your customers about digital banking? Is it privacy of personal data, account hacking, unclear terms and conditions, system failures during transactions, or lack of support when something goes wrong? I think we can look at the poll. Okay, so privacy of personal data, account hacking, and system failures during transactions, neck on neck, all of them at 25%. Okay. And then lack of support when something goes wrong is at 18%, and unclear terms and conditions is at 7%. Thank you very much. I think we can proceed to the next. Yes. So, managing cybersecurity risks. So, I want you to compare cybersecurity to protecting your home. Strong authentication methods like having a strong front door with a double lock. So we have two-factor authentication, biometrics. We have firewalls, intrusion detection, and endpoint protection. We need all of this in order for us to have strong authentication methods. Then encryption of sensitive data is like putting valuables in a safe. If someone breaks in, they cannot be able to steal because they would have to open the safe. Regular software updates and um, patch management is like fixing broken windows or upgrading an alarm system before thieves are able to take advantage. And employee training and awareness programs are like teaching everyone in the house not to open the door when strangers come. We can go to the next slide. So, fraud prevention is like building layers of protection around your money. When you look at real-time transaction monitoring, think of this as your 24/7 security guard. Every transaction is checked instantly against normal patterns. If something unusual happens, like a card being used in two countries, within 5 minutes, the system will flag immediately. Because in reality, I cannot be in two countries at one time. The behavioral analytics goes deeper than just looking at the amounts. It studies how customers usually behave, where they shop, the devices they use, and the time they take to transact. Anything outside this is deemed as suspicious. For example, a customer who normally makes small purchases from grocery stores all of a sudden starts transacting online. That for big amounts. I'm not saying that I cannot transact online, but what is it that has made me now want to start doing large transaction amounts? Limits on authorization on transaction sizes and velocity checks. This is about putting sensible boundaries in place. Fraudsters often test cards with many small purchases on every, and from nowhere they'll just come and do one very large purchase. By limiting how fast and how many such transactions can be made, this helps the bank stop fraud before it escalates. Yes, for example, somebody trying to withdraw 5 times within 10 minutes. That's not possible. Normally, when you go to make a withdrawal from the ATM, you have already decided how much you want to withdraw. And in normal cases, we don't want to spend too much time at the ATM. We'll try and make a withdrawal with one huge amount if possible, but something close to what it is that we want to spend. Yeah, I think we've covered this. Customer alerts for suspicious activity. Here, customers become part of the defense system. So, sending SMSs, emails, or app alerts for unusual transactions gives customers the power to say yes or no to fraud. We can go to the next. Operational risk is about reducing chances that internal failures will occur, whether from people, from processes, systems, or external events with that will disrupt business. In banking and finance, it is critical because a small breakdown can trigger financial loss or reputational damage. It's important for us to have business continuity planning that is robust and and a robust disaster recovery, and yeah, that is in place. Technology resilience, regular system maintenance, and backup servers and disaster recovery sites. It's also important to look into vendor risk management. There's need for due diligence before you onboard service providers. Yes. As we have seen, operational risk mitigation is not just about preventing breakdowns, it's also about building resilience. But resilience today is not built in the same way as it was 10 years ago. Technology, especially AI, is now part of the toolkit. You can go to the next slide. So I just wanted to find out, is your organization currently using AI to mitigate, to manage risk? So let's see how we're doing in the poll. So 41% are not yet. 5% extensively. That's interesting. I like the yes in limited ways. No, but planning to. That's good. We'll eventually get there. Thank you. So we can go to the next slide. So imagine a world where card transactions are not just secure, but they're smart, where every risk is anticipated even before it surfaces. In the digital age, the landscape of risk management is evolving at lightning speed, especially in card business, which sits at the intersection of finance and technology. So the integration of AI and machine learning, this brings smarter detection and prediction of threats, behavioral analytics for fraud prevention, enhanced personalization while safeguarding security, regulatory compliance and adoption, align with evolving laws like data protection and AML regulations, customer-centric risk management. This is balancing security with convenience and trust, continuous innovation and monitoring. Dynamic risk management keeps pace with digital transformation. So just in summary, before we start the Q&A, in summary, successful digital banking relies on identifying key risk areas, assessing and prioritizing risk effectively, managing cybersecurity threats through technology and awareness, preventing fraud with AI monitoring and analytics, mitigating operational risks with robust processes and training, embracing the future with adaptive, customer-focused, and technology-driven risk management. The future of banking isn't just digital. It is secure, resilient, and proactive. Thank you very much. That is the end of my presentation. Let us reflect and ask questions or provide contributions.
Thank you, Talitha. Right now, there are no questions in the chat.
Okay.
But as soon as there are questions, I will just read them out to you, or we will give a participant the floor to speak.
All right. So maybe while we wait for questions, is there anyone who'd like? Oh, I see a question. What steps should a microfinance institution follow to integrate? Sorry, it's moving too fast.
Okay, so the first question is from Patrick. Explain a bit on integration of blockchain on cards monitoring transactions.
On blockchain, I know that there's transparency on blockchain, but I'm not prepared for that question. But I'm willing to get back to Patrick and to give him an answer. Thank you.
The next one is from Armand. What steps should a microfinance institution follow to integrate AI in risk management step by steps?
Okay. No, I don't have the steps for step by step for a microfin.
Can I go to the, so here,
Yes.
Dumelo is thanking you for the fruitful presentation, and I would like to have your view regarding the negative side of AI on digital banking.
The negative side of AI on digital banking is you have to be careful how much of AI, because like anything, it has a good side and it has a bad side. I'll give you an example. Like where I work, we're not allowed to use ChatGPT for our research, because if you do, in the process of doing that, you could expose the bank to fraudsters. So even in digital banking, I don't think AI is the answer for everything. I think AI should be used to improve or to enhance, but not solely depend on it. Thank you.
Thank you for that answer. And then the next one is from Tony. There's also other students that are appreciating the informative presentation. Then Tony's asking, I would like to know how the card industry in banking is using AI to help curb card fraudulent transactions.
Okay, so what I know is that the card schemes, when you look at Visa, MasterCard, the top card schemes are always coming up with better ways to protect the card industry. So initially, when you look at the cards, initially we just used to use the mag stripe, and then fraudsters got ahead of us. So then we moved to chip and pin, and now there's been contactless. When you're doing transactions online, your card can be tokenized. There's even dynamic CVV. So this is how the card industry is using AI to mitigate fraud. Thank you.
Thank you. So we also have from Olivia, how does the risk change with the rise of instant payment systems?
How does the risk rise with instant payment systems? So the problem with instant is if you make a mistake, it is gone. So I'll give you an example of what happened in Zambia when NFS, which is the National Financial Switch, created interoperability. So what it meant was I could be, as a person who has a bank account, I could be able to send money to someone who has a mobile banking account. So to mitigate that, what they had to do was to ensure that there could be a name lookup. Because if I just follow the phone number, there's a possibility that I could make a mistake by just transposing one number. But with the name lookup, what happens is I'm able to confirm that this money is going to Talitha Bulaya. If it's not showing the name Talitha Bulaya, what it means is that is the wrong person whom I'm sending the money to. So this is what happens when things have been improved. It just takes one mistake and the money goes to the wrong person, and that creates a financial loss. And as an institution, banks and financial institutions have a right to protect their customers' funds. Thank you.
Thank you. Then we also have a question from Bahrain. I'm so sorry if I'm not pronouncing your name correctly. He's from Ethiopia and is also a certified gender change maker. So he has two questions. I'll start with question one. Regarding digital lending, in the absence of a formal credit bureau, what specific non-traditional data points, for instance, mobile money transaction patterns, social network connectivity, utility bill payments, have you found to be most predictive of credit worthiness in Ethiopian context? And how are you validating these proxies against actual repayment rates to avoid inherent biases in digital lending?
I think you meant in Zambia. I don't know about Ethiopia. I know I'm supposed to research, but no, I didn't know how to find out about Ethiopia. So in Zambia, what they will follow is, like, for example, the money that comes into your account, the frequency, and how much of that money that you get. The other way will be, so based on those transactions, the frequency and the volume, based on those transactions, they will then allow you to borrow a small amount. So in Zambia, we have kwacha. So, okay, or if you want, I can use dollar. So they'll trust you with $10 and tell you that you need to pay by this time. So you can either agree to pay within 14 days, or you can agree to pay by the end of the month. But they'll give you a favorable rate for the lower period and a higher rate for the longer period. And if you pay on time, this will allow you to be able to get larger amounts. So you'll start from $10, then they'll trust you with 25, then they'll trust you. It will keep scaling up. So I find that to be a more favorable way of doing a risk assessment on someone who has a mobile money account. Thank you.
Thank you. And then he also asked, given the challenges with a uniform ID and physical addresses, what innovative collection mechanisms are you employing at the pre-delinquency stage to mitigate the need for traditional physical recovery, which is a major NPL risk in this environment of digital lending?
Okay. In Zambia, you cannot use a physical address because I don't think you'd find the physical place. Sometimes even the Google Maps will tell you that you've reached your destination and yet there's a wall fence. So that wouldn't work. So yes, digital lending is high risk, and I cannot start to fathom how the NRC and in Zambia we call them the national registration card. So you spoke about a static identity and a physical location. Even in Zambia, that wouldn't really work well because sometimes you find that two people have got the same the same identity, national identity, and for you to correct that, you have to go physically to the National Registration Office. So lending at that level is very difficult. But what I've noticed in Zambia, people have created what they call village banking groups, where people put money together in a pool, and from that pool, they're able to lend to each other because they know where everybody stays. That way it becomes easier for them to hold people accountable and for people to be able to pay back on time. That normally works. I think I could give it a 7 out of 10. Thank you.
Great. And then Shireka is asking, can you please mention top banks in Africa which perform best in preventing cybersecurity risk as benchmarking for others?
Okay, could I please have that as my homework so that I can get back to you?
Okay, great. Then let's see. We have one more question in the chat from Chijoke. So there's so many platforms, example, Oridian, Joakali, etc., that neobanks or digital financial institutions use in their operations. Not many of develop homegrown digital core banking systems. So how can these banks or DFIs ensure that these white label platforms provide and maintain data privacy for their customers without passing the cost of services to the customer?
Okay, so on this one, you're talking about data privacy? Is that the question? Maybe you could just type for me in the chat. Chijoke, could you just refine your question for me so that I know whether your question is based on data privacy? Because when you talk about neobanks, are you also talking about based on data privacy? I'll take that as my homework as well.
Okay, good. So we have Namatai who has their hand raised and would like to unmute and ask you a question. Namatai, you can go ahead.
Hi, everyone. I had asked a question in the group, and I heard you say it's the last question, which I'd asked if AI and machine learning is effective in estimating customer propensities. Since I saw it has been noted that it is a future of risk management.
So, Namatai, sorry, what's your question again?
My question is AI and machine learning effective on customer on estimating customer propensity in digital banking?
Okay. Hmm. I need to get back to you on that one as well, Namatai.
Okay, thank you.
Do we have any more questions?
Let me check. So in the Q&A, we don't have. Let me check. So this is just a comment from Chantal. Strict parameters are so important in environments like Azure, who focus on compliance and working within Microsoft 365 and working with AI within safe environments and safe parameters. It's great. So that was Chantal's comment in the chat.
Okay. And if anyone would like to comment on the questions that have been raised, please feel free to do so.
Chijoke, if you're able to, could you please raise your hand and unmute? Because Chijoke is saying customer propensity for what exactly they're interested in answering Namatai's question.
Sure,
Chijoke,
you can go ahead.
Hello, can you hear me?
Yes, now we can hear you. You can go ahead.
Okay. All right. So I wanted to find out, good afternoon, everyone from Nigeria. I wanted to find out what the last speaker that was unmuted. Okay, customer propensity in digital banking. So, I mean, I want to understand propensity for what exactly? Because there's different degrees of, behavior that you want to determine or optimize as the case may be. So, I mean, Namatai, if you could
So, Namatai, we're inviting you back to the floor. If you could speak, please.
Okay, thank you very much. I was saying there is an order of churning in the businesses, in a business setup. So I wanted to understand if AI and machine learning is able to effectively predict the customer churning propensity in the business, if customers are going to do an early churn, a late churn, and the cost of churning. So yeah.
All right. Thank you, Namatai. I think that AI and machine learning can really do that, but it will do that based on parameters linked to customer behavior. And those parameters are either linked to the saving behavior. So if the saving behavior is, one too many distances apart, like if person is saving for lengths of time that are widely spaced, then it can bring that up as a parameter. Secondly, you could also look at repayment style for a customer that's taking a loan. If there are defaults that are occurring, too often, the system may flag this customer as someone who may leave the banking institution. That's the second one. Thirdly, again, another parameter would be in terms of how often the customer also responds or the manner. AI is actually more advanced now. There are ways people answer you on the phone call if you're a customer service representative that the AI might interpret from the tone or the voice that this customer may likely leave the institution. So they're mirrored of all other kind of parameters. It just probably depends on what core banking system you're using and what parameters may be set. But yes, there's a likelihood that the AI tools that we have now that are advancing every day can actually decide or determine what level of churn rates may occur based on customer behaviors. Does that answer your question, Namatai?
Yes,
You're
thank
welcome.
you. It shows that it's effective.
Okay, I see a hand from Brighton Casaro. Brighton, you may go ahead.
All right, thank you. I'm not sure if I'm audible.
You're audible.
All right, so I wanted to add to the propensity model question, and rightly put by the last speaker, that is very effective. I remember in one of the past institutions I worked in, we actually used propensity models to predict the churn rate of customers, and one of the areas that we looked has been on book, the age of the customer, and the behavior in terms of transactions patterns, the turnover in the account. Now,
Sorry, Brighton, you're breaking. Brighton, if you're speaking, we can't hear you. Okay, we seem to have lost Brighton. Sorry, I can't say the name of the person. I can only read Maurice. You can go
Hello.
ahead. Hello.
Good morning, everybody. I'm Toussaint Marius. I'm from Burkina Faso. My question is to know how can I determine whether the AI system being using for fraud prevention is safe and not harmful.
Okay. All right. So maybe before I answer your question, Brighton, I see you are back.
yes, thank you. Can you hear me?
Yes.
Okay, so I wanted to add to the propensity model question, and I wanted to say that yes, it's very possible now to incorporate AI, as rightly put by the last person who was answering. In my last work, one of the things that we did was to use the propensity models. The factors that we looked into were obviously the age of the customer, how long the customer has been banking, the turnover in the account, how many times does this customer make withdrawals and the transfers. Now, that process was highly manual. Right now, with AI, you can simply automate. Within a few seconds, if not a minute or two, you can get that model given to you. And using that model, you then put in interventions to try to keep this customer from churning or going to competition. So, yeah, it's very, very useful for any business to use AI to use different propensity models to manage customers. Thank you.
Thank you. All right. Thank you, Brighton, for that contribution. So, Maurice, you were could you just repeat your question? Okay? I think it's the one that is here. How can one determine whether the AI system being used for fraud prevention is safe and not harmful? Off the top of my head, I would say that the most important thing is to be able to do due diligence on the provider of the AI. The fact that it's AI does not mean that it is the best thing. I don't know if anyone else would like to add to that, but I think for me, it's important to evaluate the system and the source of the system, and also look at whether that where else that same AI has been used before you go ahead and you implement it. Thank you.
Thank you, Marius. I hope that your question was answered. So we have one more student who has a question, Julius. So there are two questions. Question one, how do banks guard against cyber fraud that is orchestrated from within, like with insider men, because they know all corners of the system?
Okay, so without going into too much detail, we have robust systems that are able to detect where, for example, if a gadget from outside has been added to the system. And it's amazing how they will even be able to locate where exactly you are. So first of all, the most important thing is to educate everybody within the bank, tell them the do's and the don'ts, and tell them the repercussions for introducing systems or trying to defraud the system. That way, each one of us is alert. One of the things we've adopted, like in our bank, is a clean desk policy. We do not allow people to just walk into certain areas. Whoever comes in must be accounted for. And also, the continuous learning helps us to be able to detect. Sometimes you can see that your colleague is doing something wrong, and you can be able to advise them. That would be my response. Thank you.
Okay, great. So that is all we have for questions today. If your question wasn't answered, please go onto the LinkedIn event. The other questions will be answered on there. There's also a link in the chat to our LinkedIn event. Talitha, there are no further questions and you can conclude.
Thank you very much for your participation, even for the questions asked. I promise to get back to you on those that I couldn't answer during the webinar. From Zambia, I wish you a wonderful afternoon. For those waking up, good morning.